We are here at Decipher, Algorand's crypto conference in November 29th, 2022, and I had the pleasure of being joined by Massimo Morini, Chief Economist at Algorand. Massimo, welcome. How are you doing?
I'm doing perfect. Thank you very much for this interview, Jack.
It's my pleasure, Massimo. I'm doing a lot of interviews here with investors and entrepreneurs in digital assets. And I love that it's a little bit outside of my realm of expertise. You know, my podcast, Forward Guidance, mostly about the traditional financial world, central banks, inflation, growth, macro. And so I know that is where you spent most of your career before you joined Algorand. So I'm thrilled basically to talk with someone about, my lane, so to speak. So tell us, what was your journey? You were an economist. Where did you work? What did you focus on? And sort of what drew you to the field of finance?
Well, I am an economist by training, but I've got to say that by trading, I've been a mathematician for a long while, because I took a PhD in maths for financial markets after my MSc in economics. And I've been working in traditional finance. That's the way we can call it. I've been working with markets, with banking for almost 2 decades. And it is there, that I have experienced the financial crisis. I've written several books about that, several books about the problems that arose at that time and which solution we could find. And many solutions were about the technology. That's the journey that led me to become interested in blockchain technology around 2014, 2015. I was a board member of R3. It was a consortium of banks that wanted to use essentially blockchain technology in traditional finance. It is there that I realized that the traditional finance world was moving very slowly compared to the incredible power of this innovation. So after moving to actually experiment and work with essentially financial structures in public blockchain, and actually met Silvio Micali, the Turing Prize, that was creating Algorand, and I became chief economist at Algorand, joining the foundation essentially a few weeks after launch. And then it has been an incredible journey of 3 years into this amazing reality of public blockchains.
So in your training as an economist, were you focused on the general economy, like inflation, growth, interest rates? Were you focused on a particular asset class, stocks, bonds, commodities, market structure, or the combination? What was sort of your focus? Technology?
Well, I've been focusing on technology. I've been focusing on markets, essentially, and I've been focusing on financial products and risk management, essentially.
Mm-hmm. Okay. And so you said you wrote several books about 2008. What were your key findings there? What was the root of the cause? And do you think that when people, the mainstream understanding of 2008, when people look back, do you think that mainstream narrative is correct, or do you think it's incomplete?
No, it's partially correct. It's something that can happen, when the market is growing too much and forgets what are the roots of its growth. Often in the growth of a market reality, there are some fundamental principles, some fundamental rules, or some fundamental techniques, and also fundamental ethics that allow a market to grow and actually to expand its economic strength. At times, when it reaches a peak, some people start forgetting about these fundamental principles, and in that moment, you are bound to see a crisis. That's pretty sure.
And so what are those fundamental principles? Do they have to do with assets and liability matching, sort of borrowed money? What were the principles that were violated in 2008?
Well, in 2008, for sure, principles about sound risk management, aligned incentives, and particularly a correct management of model risk were certainly violated. Some assumptions that were maybe correct for a while continued being used when they were no more, and some good principles to make financial projects sustainable were essentially forgotten. We may say that was greed, we may say that was misaligned incentives, so people taking decisions were no more aligned with people actually acting in the market, with the real economy around the market. And then obviously we could write, books with a lot of mathematics and science and data about that. But the general paradigm can be recognized from that crisis and from other crises.
Right. So I'm from the U.S. and I feel like in the U.S. we really focus on subprime mortgages and then the structures that were put into there, and that was tons on the bank balance sheets. I feel like in Europe and the rest of the world is a little bit different because they were buying a lot of those securities from the U.S. So that's different. And then also the U.S.'s recovery was much better than in Europe. The European recovery from 2009 onwards was quite stagnant, quite rough. What was that period like? And what was it like with the European debt crisis, where bond yields started to explode higher in other countries such as Greece, Portugal, as well as Italy?
Oh, that's a very good topic, because also brings us probably nearer to what then became my main interest in my research, in my career, in my job. Essentially, what happened? It's true that in a sense, Europe was a little bit less involved in triggering the crisis. And it was not so difficult to understand that at some point, exposures had to be reduced rather than increased. But when the crisis had started, obviously the situation was different. That there was a need from a strong intervention from, let's say, from central banks and from regulators. And at the same point, there should probably have been more effort in order to make sure that even without so much help from the public sector, the private sector could stand on its legs. And at that time, I started reflecting on what was making at times, the books of financial institutions to be so weak. And the fact is that one of the biggest problems that emerged at that time, I would say the biggest problem, was actually credit risk. And one very common solution to deal with credit risk was using collateral. And exactly at that time, there was a very important understanding and an important shift in market habits about over-collateralizing exposure to avoid being subject to too much to credit risk from your counterparty. And so I started to say, why this collateral ends up not being as effective as in principle or in theory it should be. And I realized that there were several things. First of all, setting up a top-class collateral agreement was not easy for many institutions. And even if you thought of top institutions or largest European or American banks, essentially all the financial agreements were associated to paper contracts that could be interpreted in different ways, and they were at times interpreted in different ways. They were based on models that could be very different across the different institutions, and the data used could also be different, and some of better quality and some of worse quality. Additionally, collateral was moving slowly compared to the speed of financial markets. And even more importantly, when the worst actually came to the worst, collateral was not being so efficiently moved where needed as it should have happened. And so it happened that when I looked at the blockchain technology and I looked at smart contracts, I started to imagine how different the market could have been, on such a platform. And I noticed that, obviously, on a platform based on smart contracts, all the uncertainty about, the details of the contract and how it should be implemented, or which data had to be used as a feed, or which model, in a sense, was used to actually compute the amount of collateral. That was embedded in the smart contract. And everyone actually participating to that market was on essentially the same level, a big, strong level playing field force, 100%. And then I also realized that the differences between institutions, for example, corporate had more difficulties, to manage this technology or even to move liquidity the same way as banks. But when everyone was on the same platform using the same technology, also this difference would have been eliminated. Not to mention the increased transparency in dealing on a blockchain. And then I realized that some technologies, and for example, that was one of the reasons behind myself joining Algorand, actually allowed really real-time transaction with real-time settlement and with actually real-time settlement finality. It was one of the biggest things creating uncertainty and losses in traditional finance. And then I started to design the possibility for financial agreements that were over-collateralized, with actually collateral being automatically moved when market movements made it needed, to protect someone from credit risk. And I wrote a few papers. I remember CFTC quoting some of my papers when they were presenting to the US Senate about blockchain technology. And that was back in 2015. And curiously, for many years, nothing happened in traditional finance, And then, incredibly, or maybe not so incredibly, it was actually the world of public blockchain that created DeFi and essentially implemented these ideas, implemented these mechanics, And it's interesting that even in this bad year, that we have seen for the cryptocurrency markets and from markets using blockchain technology, the big issues have happened where the principles of the centralized finance were not followed. You can think of the SBF crisis, which is totally into the paradigm of centralized finance, Unfortunately, putting together the worst of centralized finance with, for example, some advantages, in moving freely assets that came from blockchain technology. Or also, if you think of Terra Luna, where in principle was a decentralized project, but you cannot really have a decentralized project where, in a sense, some parameters are artificially kept, at unsustainable levels, essentially because of decisions of people, and it was really the most amazing, realization of what we were saying before. When you have something where collateral is fundamental, for the working of a financial agreement, you cannot lower collateral, to the limit in which that's even a little market movement brings collateral below exposure. In a sense, that crisis came from the same problems that led to the financial crisis. The same mistake that everyone was supposed to know after the financial crisis, that it was a big mistake.
Yes. Very liquid liabilities and extremely illiquid assets.
Absolutely.
Yeah. So this vision that you had in 2014, 2015, you started to get into blockchain. You started to write papers about collateralization that could be done on the blockchain, on smart contracts. That was your vision in 2015. Had a lot of developments since then. I want to talk about Algorand, but safe to say that what happened in November of 2022 with FTX is pretty much the opposite of that vision. So what happened over those past 7 years that was different than your original framework? Because I feel like there has been a ton of activity, investment in blockchains, in crypto, and you've seen like a lot of extreme bull runs. I mean, the price of Bitcoin is probably beyond your wildest dreams that you had in 2015. But then there's the other side of sort of onboarding real world assets of, let's put Italian BTPs on the blockchain. Let's put Greek bonds on the blockchain. And that's, another journey that perhaps has not gone as far. So yeah, just walk us through, we're at 2015 now. Walk us through 2016, 2017, and ultimately joining Algorand and how you've been thinking throughout that.
No, that's definitely a good question. Because it's true that first I noticed that traditional finance was not moving as fast as expected, and was not going into a real direction of innovation. It's also true that now we have to reflect on the direction that instead the public blockchain world has actually taken. And what can I say is definitely, there has been a moment, it's a little bit what I was saying, when the boom actually attracted projects that were only boom projects, trying to put together the worst of traditional finance and the worst you could do with cryptocurrency. In a sense, this may have, in the medium run, the positive effect, that only the projects, that we're trying to put together the best of traditional finance and the best of blockchain technology and decentralization, actually we remain. That's one possibility. And it's certainly true that everyone welcomes, new money coming to a reality, so important, so complex like this new technology. But new money, can actually, particularly if it is big money or very small money, that can disappear as fast as it appears. Well, let me say that average money and durable money give much more stability, when a reality is developing. What I am expecting now, eventually, is that the two words, traditional finance and blockchain, are understanding, the importance, in a sense, that they come together. So I believe that now is the right moment in which actually traditional finance can come to blockchain and actually understand really what the blockchain can do, and not only thinking of that as a way to make easy money, but as a way actually to be able to do better, the kind of services that they are supposed to give with this technology. And it's also the moment in which blockchains and the reality of cryptocurrencies have to look at traditional finance and realize what they have to do in order to be more effective, for more people and with less risk. That's my view about the future.
And what would you see, obviously it's all of these, but what would you say is by far the biggest use case over the next 5-10 years? Would it be NFTs, stable coins, store of value, sort of collateral assets, or real-time settlement on the actual blockchain of real-world assets like bonds and commodities? Again, it is all four of those, but what do you think is the number one?
Unfortunately, it's hard for me, because for me, almost, not necessarily all you mentioned, but almost all you mentioned is one thing. If you talk about,
What do you mean? What do you mean it's one thing?
I'm going to get into that. When you say NFT, essentially for me, NFT is the Internet of Value. It means that you can use the Internet as the real foundation of a network of value. Network of value includes a financial system, so a system of transaction. It includes digital assets, digital value that may be actually self-generated and totally decentralized like most of the NFTs, or can be a product, created by an institution or even coming from the traditional world. And so I definitely believe that blockchain settlement also for payments is crucial. We have seen it for cryptocurrencies, and now many people are talking about CBDC. But there is an entire world in the middle, about the ways in which money has been issued in the last 500 years, for example, from the banking system, has been the fuel, of all the incredible growth of modern economy, the fuel of today technology, up to a point, even the fuel of scientific growth. But in a sense, it's still based on a logic of ledgers, of a technology of ledgers, which is almost 500 years old. It was created based on double accounting in the Italian Renaissance, say the truth. Yeah. Some words, about corresponding banking still come from Italian because of that. It was so funny for me, when I was actually noticing that. And blockchain technology is exactly about the most radical innovation of the logic of ledgers, of the logic of transactions that we have seen in the last 500 years. And this can become a foundation for also the money which has been issued, by the banking system, by traditional financial institutions. So I'm imagining a world in which obviously there needs to be a role of the central bank, in managing this reality, and everyone knows, but also that doesn't go into a direction of centralization, but it still increases decentralization. Decentralization can mean financial institutions as we know them now that improve themselves and get better. We can imagine realities that already now are creating digital assets on a blockchain that get more into the space of actual payments, and that's going to be a great revolution. And I also think that DeFi and its possibility of actually using technology, so obviously being subject to a technological risk that is going to decrease in time, but is obviously still present, becomes also a technique actually to keep credit risk at bay, because we have seen how big it is. So obviously you are not addressing, for example, market risk when you are in DeFi, but you are giving an incredibly new answer to credit risk. And one day I think that more decentralized finance can embed even additional forms of risk management that go beyond, just the automation of over-collateral, as we were saying. And under this point of view, I think that Algorand is doing great things. There has been a very interesting paper recently about allowing delivery versus payment or atomic swap. If you come probably from TradFi, you understand better delivery versus payment. If you come from blockchain, you understand better atomic swap. But this was done, on Algorand, with a leg represented by a digital asset and the other leg represented by central bank money on the European system. The paper was published by the Bank of Italy. And I think that our DeFi is also doing great things because it uses a technology, the one by Algorand, that has got immediate finality, that has got some features, that make it particularly suitable to actually see the promise of decentralized finance realized. That are some of the most interesting things I'm seeing nowadays.
Thanks, Massimo. I'd love for you to explain a few of these things. I come mostly from the traditional finance world, so a lot of this is over my head. When you say, what is an atomic swap? And also, I imagine it is on the Algorand blockchain, but is that necessarily including Algo, the cryptocurrency, or not necessarily?
No, not necessarily. And essentially, we are still talking in a sense about credit risk. One of the biggest issues that you may have nowadays is that I think that was the first issue of trading. The first issue of trading is that when for the first time human beings, decided to move to a trading economy, that didn't happen immediately, or the human being starting from a family or tribal economy, where in a sense, trust was taken from granted, as it happened nowadays, within a family. But when they decided to trade with other groups of people, the issue of trust immediately emerged. And so the moment in which they had to meet to trade, that was a moment that everyone feared. What happens if these guys, take actually what we have brought and don't give us what we were expecting to receive? This problem, up to a point, is still there, and it's what traditional finance call delivery versus payment and what blockchains call atomic swap. So if we agree that we want to exchange an asset, who is going to go first? How to make sure that I'm not transferring to you, for example, the payment for an asset, and then you run away and I see no asset. That's credit risk. I've lost everything. The blockchain has given surprising and brilliant answers to this. Within a blockchain, a smart contract can manage this risk. For example, keeping the assets for a period on a wallet which is kept by the smart contract. Or you can even, in Algorand, for example, having an atomic swap that does it just with one transaction. But think that this needs to happen between a digital asset living on a blockchain. May not be a cryptocurrency, may even be a representation of a more traditional asset, but it lives in a blockchain to enjoy all the positive properties of a blockchain in transaction. And then it's maybe to be exchanged with fiat money. Maybe even, fiat money, central bank fiat money, as it happens in large transactions between financial institutions. Essentially, what has been done in the paper that I was mentioning was creating a mechanism that uses blockchain technology and uses, in a sense, blockchain technology both on the blockchain leg and in part also on the traditional finance leg, in order to make sure that every two parties, where one is actually transferring a digital asset on the blockchain, and the other side is transferring, central bank money on the European payment system, can trade and make sure that through smart contract, actually the trade is only happening when both legs are happening, protecting both sides from any credit risk. That's what we're talking about.
So it's like clearing and settlement. It's automated settlement that you don't need a counterparty in between.
And even of the exchange, exactly. You may actually trade safely with your counterparty without necessarily an exchange in the middle, without a central counterparty in the middle, because technology is doing exactly that job.
And yeah, tell me more about this paper from the Bank of Italy. That sounds really interesting. That Algorand did some work with the Bank of Italy. Typically you think of central banks as essentially in charge of fiat money to some degree, so not necessarily the automatic friend of crypto. What was the cause of that study, and what were the insights that you gleaned from it? Sounds very interesting.
I think that institutions all over the world, certainly Europe, but I would say everywhere, are getting more and more interested in blockchain technology. And I think that best institutions are understanding, the difference between some issues that can emerge in the market, because of some very specific projects or some very obvious mistakes or frauds, from the quality of the technology, and from the things that can happen. And I think that has been the driver of this research, and this is going to be the driver, in my opinion, of even more research, including, payments, including issuing assets that now come from traditional finance in a tokenized form in blockchain, and using blockchain and technology for transactions.
And payments, would that be paying in the Algorand's cryptocurrency, or in tokenized dollars on the Algorand blockchain?
No, I think that both things are possible. And I also think that, in a sense, we have to innovate also in this direction. Now we think of cryptocurrencies, we think of stable coins, we think of CBDCs. But there are different ways of probably the next generations of digital assets are going to go beyond this. Think, for example, of something like your bank deposits, but issued in a blockchain. That would mean actually with clear control over the monetary supply. This would mean that you can have to all today regulations about, converting this into central bank money and all the kind of risk management that central banks have set up. But at the same time, you could be using for transaction the autonomous transactions that you can have in the blockchain, without, in a sense, having to create institutions just to reduce risk, just to make transactions possible, because the blockchain already make them possible. And in a sense, with the full transparency of the blockchain, with the possibility of managing, any kind of, boundaries you want to put, regulatory boundaries, with the technology of smart contracts, of whitelisting. So I think, yes, that we will see again innovation, on the border between finance and technology in the next years, for sure.
A key principle in finance is par, also comes from Italian and Latin, of my bank deposit at Bank of America is, if I have $1, it's the exact same as Bank of America's deposit with the Federal Reserve, which is the same, based on the FX exchange of your deposit with Santander, which is the same as their deposit with the Bank Reserve, with the ECB. Are you imagining that this would also be a sort of a fiat par, where it would be a stable coin or something that is level, or not, in which case people would have to take price risk of a certain asset? And of course, we all live, I live, most people live in a fiat mindset of the price risk. If you hold Bitcoin, that's a risk. But of course, if you own dollars, you're exposed to the risk of Bitcoin. But yeah, do you think it will be in a fiat denominated thing that is on the blockchain, or will it be people with crypto denominated? And in which case, can you speak to sort of the public perception of, if I'm very bullish on Bitcoin, why would I go to the store and buy coffee with Bitcoin? Because I'm selling my Bitcoin, you know?
The interesting thing about blockchain technology is that it allows exactly to start from all the things you said. And if we want, we could keep exactly the same user experience in terms of things like price risk. Because in a sense, you said that my deposit with a European bank or your deposit with an American bank are exactly the same thing, up to a point. They are, in a sense, both denominated in fiat currencies. We know what is the rate of exchange, but we also know that, I don't know, if I try to withdraw, at an ATM in the United States with my, debit or credit card, it's not necessarily what is happening is not necessarily the same, which is happening if I do that in Europe, or even more, if I do that in an ATM, which is from my bank.
Very
exactly.
true, very true.
In
you
a
get charged a
sense,
fee. Like I bought something in Dubai with my American credit card, I got charged a fee.
I could put a limit to how much you can withdraw, which is different from the one you have at home. Exactly all of these things that, in a sense, happen, in the real world, could remain exactly the same. Because think of that. All traditional finance is based on a principle in which your authentication is based, in a sense, on an identity of yours, which is controlled and managed by a financial institution. And in a sense, as long as we want to keep this, so with the moment you go to withdraw, that's exactly what is happening to you. And the things that you do are based, on your relationship with institutions and your identity that they've checked. For an entire part of the world, the one you are talking about, we could keep exactly the same experience. Because at the same time, blockchain is based on a different form of identification. It's an identification that everyone can create for themselves. They can create an identification, creating, a key pair when one identifies you and the other one represents for you your way to digitally sign your way to show that it is really you. And that's what makes transaction much more efficient, because it does not require, the presence of an intermediary just really to move, to push things happening, but things can happen with automation. But at the same time, you can associate this way of acting, of transacting on platforms, with your identity and the control of your identity that we are used to in some parts of traditional finance. And you can put together the best of the traditional world, that experience you were talking about, and the best of the new world, the possibility of transacting and actually to participating into financial, organizations in a much more efficient way, in a much more transparent way, in a much more seamless way, where the presence of an intermediary does not become a problem rather than becoming an advantage.
And in this world, people could pay in fiat on the blockchain or in crypto, or only crypto?
Oh, definitely also in fiat.
Okay,
100%. Yeah.
And you see that as a very big on-ramp into crypto? Yeah.
I think that's a great thing that could happen in the world in the next few years. But, as it happened to me in 2015, I'm not going to say that it's going to happen soon, but I see that.
Could you walk me through the Algorand ecosystem and specifically the cryptocurrency algo? And let's say that, Algorand becomes extremely used on this settlement layer. Do some proceeds of those go to sort of burn algo? So for example, I know, to speak of another project in DeFi, Uniswap, it is the dominant decentralized things for automated market makers, decentralized exchanges. However, I believe none of that money generated goes to buy you back Uniswap. So even though Uniswap is a dominant protocol, the token has performed very, very poorly. Can you speak on just the sort of tokenomics of algo? And also, sometimes tokenomics can be, quote, too good, and they don't focus enough on growing the ecosystem. They focus too much on proper, increasing the coin.
There is always, this trade-off. We all know that there was an idea of scarcity that has been implemented by Bitcoin that had some merits, and also it allowed Bitcoin to become a store of value. But we also know that in that way, no resources went, into developing an ecosystem. We have also seen the opposite, actually all resources, spent out and no attention, into keeping, what was supposed to be distributed to the community remaining, inside the ecosystem. As we are now, tokenomics will always be divided, between these two extremes, and we cannot yet, as the Terra Luna reality has shown, think of a tokenomics, that gives you perfect price stability, or that gives you no unexpected events, At the same time, I believe that what we are experimenting in tokenomics is amazing, because it goes to one of the fundamental roots of a stable and sustainable financial markets, which is correct incentives. And even if that's still, for a big part, a big experiment, incentives are crucial in every market, and incentives are crucial in every economic system, that flows in a market, which means that, flows almost in real time. And so you need to have things that act in real times as incentives actually do. And so I think that remains a fundamental and very important piece of research. And it's great that with the blockchain, we're not only looking, at incentives for, financial institutions or rating agencies or pension funds, the kind of incentives we would be talking about if we're talking about the financial crisis. We are also talking to bring inside the world of incentives also ultimate users, and that's a great thing that the blockchain is showing, even in these days in which we are seeing so many problems.
But before I move on to macroeconomics, central banking, my final question is why Algorand? So in 2015, you start to really focus on blockchain and the power of its technology. You had the ability to join many other what is known as layer ones, but you chose to go Algorand. What was it that, why is Algorand number one to you?
Well, I met Silvio Micali at a conference on parallel computing, and I found out of this project, and we started debating, his incredibly mature view in terms of technology, and all the things, I had been, working upon related, essentially more to the financial and economic side of building blockchain technology. And I saw, the superiority of the technology, and I saw how some features, from the protocol that is a protocol, that starts, by the way, for example, agnostic to any form of incentives, which makes it, in a sense, innerly efficient, because its security is, first of all, based on the mathematical algorithm, which is, has got a level, of mathematical security that you usually don't find in other protocols. And also, it allows you to have immediate finality. It allows you to have a particularly efficient transactions. And
sorry, what is finality, and why is that important?
Yes,
sorry,
very important. Finality is something that whose importance was understood totally in the traditional world. Even if we at times don't realize it, all the traditional financial and property systems has been created in such a way that if there is a contract that, the day after you realize that maybe that's not exactly what you wanted and so on, and you want to change your mind, that's usually possible, going through the legal system. But the moment in which, 1 month ago, there was an exchange of property and so on, going back to that is more difficult. And that's important to give certainty, to trading. If you believe you now own one thing, and then tomorrow you wake up and you don't own it anymore, you couldn't see, the economic growth that we have experienced. That's finality. And that's what the logic of forks that were very natural, in a sense, in the initial blockchain reality.
Bitcoin Cash.
Exactly.
Yeah.
Could become, but not only, the forks that could happen, even within Bitcoin, that at some point, allow you find out that the blockchain that yesterday for you was the blockchain, in a few hours had been turned into another blockchain because of a fork, And even if, in spite of this, Bitcoin and even Ethereum, when they had proof of work, they were able to grow, they were able to show the power of blockchain technology, yet that remained a serious problem, from any application that went beyond a limited experimental world, and that's finality, that's very important, is the fact that when a transaction has happened, it's certainly not technology, it's certainly not, a mistake in settlement that brings you to revert the situation. What the transactions that happen have happened and will not be, turned back by anything like that.
So Finality is essentially guaranteeing that there will not be a fork.
Exactly.
What is it about Bitcoin, Ethereum, many other cryptocurrencies that required a fork, and why is it that Algorand, you say, does not need a fork?
Well, in a sense, the risk of a fork is the one fundamental risk when you want to decentralize, a system of value. I would say that every, Bitcoin or every other projects on the blockchain that is public and starts decentralized is in a sense a system of value. It's like a group of people that say, guys, now we want to create either our own coin or our own digital representation of value. And we start saying, everyone needs to have a way to actually prove their identity, and digital signatures based on asymmetric cryptography are a fantastic system because that doesn't require us to have a central manager. It doesn't require us to have an intermediary. Fantastic. Then we have peer-to-peer distributed technology, on the internet, and that again allows us to set this up without having to put a central administrator that decides everything, without intermediaries and so on. Everything seems perfect, but you still have the risk of a fork. In a sense that if everyone was behaving honestly, everything would go well. But the moment you go out, of a family, a classroom at university, you have to deal with that risk. And, in this system, the biggest risk is that one player, in order to make a fraud, or purely in order, to hack the system and actually to be malicious to what are the purpose of the system, can actually fork, can send different transactions from himself that double spend money. And essentially, all the big complications that people talk about, proof of work, proof of stake, and so on, is a way to make sure that without centralization, yet the network agrees on one single version of the blockchain. And therefore, this issue of the fork is the crucial problem of a decentralized technology. And in a sense, Bitcoin was great to create a system where forks were not the norm. But still, they are possible with a likelihood that make them relevant. In a sense, now we are getting a little bit into mathematics. Algorand goes beyond along the same way, because it reduces further the probability of that. And since it is a very well mathematically controlled, system, it reduces the probability essentially to the limit to zero. That's what it does.
Yeah, explain the mathematics. I think Bitcoin, people can understand the mathematics of Bitcoin quite simply without understanding the technology of there's only ever going to be 21 million of them. There's no double spend problem. Of course, that gets more complicated when they fork into Bitcoin Cash, and then there's Bitcoin Silver, Bitcoin Diamond, and I think a lot of Bitcoin value relies on the narrative. There's only 21 million, and I think that is challenged by the fork. Although to be fair, I think a lot of forks happen, at least stated, for technological reasons. Not a fraud, but what is it about Algorand's mathematical quality that allows it, I don't know this at all, I'm not a mathematician, you are, that allows it to sort of not be forked?
Well, I have a PhD in maths, and, essentially the name of the PhD is probability and stochastic calculus. But, we have got here Silvio Micali, who created that. We have Ugo, our head of research. We actually had Adriano Di Luzio, CTO of Algorand Lab. And so, in a sense, I'm a little bit embarrassed by explaining the mathematics myself. I suggest you to watch one of the videos by Silvio that you can find online, definitely.
Okay, thank you. Well, Massimo, now let's move on back out of the world of crypto into the traditional finance world of central banks, growth, and inflation. What have you made of the very high levels of inflation we've seen in Europe and the US as well as around the globe? To what do you attribute it? What was the cause of it? And do you think that central banks hiking of interest rates is appropriate to fight inflation? Is it not sufficient? Is it overkill? What do you think?
Well, now again, I have to make a disclaimer. We are moving out of the area where I feel secure and safe about what I say.
Yes,
because that's not my area, so I don't spend the same time of thinking and finding out and collecting data as I do in other fields. My very high-level impression is that the economic system that we have experienced in the last 2 or 3 decades had something very, very clear into it. There was a lot of economic expansion, there was a lot of monetary expansion, but the system always managed not to let inflation get into consumer goods. It was durable goods that were growing in price, from real estate to stocks, to at some point also assets on a blockchain.
Mm-hmm.
And in a sense, this cycle was virtuous, because in some cases it probably increased inequality, but in other cases actually decreased inequality. Probably in the crypto space, most of the times it was decreasing inequality. And now we see a hiccup, in this mechanics. We don't know. I'm not saying it is broken down, but certainly it has somehow not been working as it worked in the last few decades. From the point of view of cryptos, this was certainly an element that affected the trend of the market. Has it affected the whole economy? From the point of view of crypto, I've got to say that I don't know how much this is related to the fact that we have been living in a world for decades where the economic freedom and international trade was continuously expanding, and international collaboration was essentially expanding. Now it seems that this process has slowed down, and in some moments we're even seeing the opposite. The blockchain is a technology, is a model for a borderless economy, which is a sentence that you can hear often, when you are in an Algorand event. And so definitely there will be some initial suffering, in a world where that is becoming less borderless than what it is. But really, these are the things that I can observe. I'm not able to say, how much this is impacting the reality we are seeing, or when and how we are going out of that.
So you talked earlier about the benefits you see of the blockchain for security, for efficiency, but what about fundamental macro variables such as inflation and growth? Do you think that a global economy that's relying on a borderless blockchain, do you think growth will be higher, maybe inflation lower and or higher? I'll give you an example. Banks, the Venetian discovery of double entry bookkeeping, that was very good for growth, because you could lend money, and now I could give you money that technically does not exist, and I could usher it into an existence. And now that maybe that's backed by gold, or it's collateralized, and that's good for controlling inflation, but not as good as growth, kind of bad for financial stability. Then the governments went off the gold standard. That was good for growth, but good for financial stability, but very bad for inflation. Then central banks, now it's the Federal Reserve's responsibility to control inflation, and all these things, financial innovation and history, impacts growth and inflation. So how do you think the blockchain will impact that, if at all?
Okay, if I can answer starting from your mentioning of double entry accounting, or even better, I would prefer to start, from the very beginning.
Yes.
Which is single entry accounting, which is essentially the moment, in which human beings decided to start writing something for the first time, a moment that we often call the beginning of history. And when they started writing, the truth is that what they started writing was not a poem, because it was something that was also using numbers and mathematics. Was that a theorem, about, how stars move? No, that was accounting. Mm-hmm. The first thing that a human being decided to write was a ledger. And that ledger was single entry accounting. There was a symbol, for essentially the good you were talking about, corn or wine or anything. And then there was a number, to say how many got in today. That was it, single entry accounting. As you said, between Venice and Genoa and Florence and Pisa. I don't want to offend any of the fellow Italian cities.
Not just Venice. Yeah.
Exactly, essentially introduced something that actually had roots in Indian mathematics and already has been transformed, by Arab applications, in the Arab Empire. And then it was applied to the economy, to trade in Europe, and one of the first big applications were actually the ledger of banks, that in a sense were the first dematerialization, we could say digitization, because that's what it became, numbers of ledgers became real money, and that allowed, for example, to transfer money across the world much faster, starting, the big expansion of economy that we have seen at that time. Some people call blockchain technology triple entry accounting, because like in double entry accounting, you have written on the ledger the payer and the receiver, of everything. Think of how a transaction works on a blockchain, like Algorand. There is a message from the person that is actually transferring a digital value that reaches a very clear, wallet that remain on the ledger. But there is something more compared to a traditional double entry accounting ledger, that always have, two accounts, one that gives and one that receives, in a sense. There is the digital signature. And some people, but this was, does even go back to the 80s, some research that was done by Carnegie Mellon by a few Japanese professors, is actually, they say, once the ledger also contains the signatures, of the parties involved, the ledger becomes also part of the contract. The ledger becomes the legal foundation of the economy. The ledger becomes more and more the actual economic reality. And in a world where so many things are digital, that's an amazing thing. And in a world that a couple of decades later had the internet, this movement towards what should be the proper definition of Web3 had to start, and it started with blockchain technology. So in a sense, yes, I do believe that it will foster more growth. Obviously, in terms of price stability and inflation, at the beginning, it may actually create a growth in scale and so potentially an issue, but it also provides the tools. Because, as you said, also in the other big revolution of the economy, at some point there were entities that needed to get in charge of inflation management. And the blockchain, through smart contract, through protocols, is also providing additional tools. So in the long run, this is going to be certainly a positive effect about anything related to inflation control.
What is your view on central bank digital currencies, and in what way are they fundamentally different from crypto? I mean, would it be possible for a central bank to adopt a blockchain or just kind of buy a blockchain that already exists? Or do you think it's very likely they'll develop their own blockchain? And are they necessarily a threat to crypto, or is there any way they could cooperate?
It's a very good question. I don't know what is the answer, because even if there is so much talking about central bank digital currencies, we are really far away from understanding this point. We're far away from understanding if and how much CBDC's design will be more centralized than anything we are seeing. If they will be centralized in management but decentralized, in technology. And my view is that it's totally understandable, that central banks, look at this innovation and obviously think of that in order to make the financial system and the experience of the users of money, of everyone, better, particularly in a world where there are still many people unbanked, when there is a world where being digital is becoming more and more a value. But remember that the fundamental feature of blockchain technology is making the experience better, because you are actually using something which is natively digital, and uses your digital platform to actually exist and to actually transact, rather than being just the digital mirror of a 500 years old reality that still happens, with messages across banks. So I think that even potentially before CBDCs, I am expecting all the other part of money. Nowadays around 90% of the money, is actually created, from the financial system. Only 10%, is, in a sense, of what is in the hands of the public is created by the central bank. So I'm sure that 10% will be affected sooner or later, but I'm expecting also the other 90% to be affected by this great innovation.
Well, Massimo, it's been a pleasure getting the chance to interview you. If people want to learn more about Algorand or your research on Algorand, where can they find you? Where can they connect with you to learn more?
Well, there is my email address. I am on the socials, and then they should come to these events to find out what Algorand is.
They should. So we're at Decipher 2022. There's going to be, I imagine, a Decipher 2023. Are there any other Algorand events, or is it what's the year?
So many, and so many are regionally in all parts of the world. So if they look at our website, they will find out many ways to get connected to the community.
Wonderful, Massimo. Thank you so much.
Thank you, Jack.